Nigerian President Bola Tinubu's reform agenda is taking shape. The West African nation has passed its 2024 to 2026 medium-term expenditure framework, tallying next year's budget and expected reform costs. As things stand, revenue of 17 trillion naira undershoots expected spend of 24 trillion naira for next year. Pieter Scribante, who's a senior political economist at Oxford Economics Africa, joins us with his assessment of Nigeria's budget framework. Peter, it's a pleasure. Good afternoon to you.
Good afternoon.
All right, as this framework was being put together, I assume that there were assumptions that underpin it. Let's talk about those assumptions and how realistic they may be.
So yes, as you know, the government needs to estimate how much revenue expenditures has, how much to increase salaries by, and what's the economy going to do. And it's a very strong signal to the markets and the fundamental basis of any budget. Now, unfortunately, there were several eye-raising assumptions that felt very similar to previous administrations, like economic growth. They expected to reach 3.8%, whereas we see it being closer to 2.9 for next year, and the IMF's in the low threes. I would say also like inflation. Currently, inflation is trending close to a multi-decade high. It might pass this peak next month or the month after that. It's currently at 27% or higher year on year, but the Nigerian government expects inflation to decrease to an average of 21% next year, which is mathematically impossible. And I have to say the largest eye raises that I've seen is to do with the oil economy. Whereas oil averaged around a 1.22 million barrels per day over the past 10 months, they expect oil production to reach the heights, pre-pandemic heights of close to 1.8 million barrels per day. And it'll take a lot for the country to achieve this.
Those are very interesting assumptions being made there, Peter. What is the most significant change in the new budget compared to previous administrations, now that we know what similarities could be?
Yes, so of course the most catching difference was the removal of fuel subsidies earlier in the year. So over the past few years, the government has spent enormous amount of money on fuel, even more than it spent on education, healthcare combined. And last year, in 2022, it captured more than 15% of total fiscal expenditures. And this being removed, of course, means that the budget deficit is more narrow. Some of these funds are being reallocated to subsidies for poorer households, which is also very new. But in general, the budget is the template that Tinubu's administration would use to fund the ongoing reforms.
Are we expecting there to be holes in that budget? And if so, how does a government plan to address them?
Yes, of course. Unfortunately, there's going to be a lot of holes in the budget. Currently, I think they estimate 9 trillion naira deficit. The government rightly addressed the sobering fact that their international sources of borrowing has been tapped out without extremely high interest rates. So they plan to tap the domestic market to plug the hole in the deficit, including the central bank and other borrowers. And on the other side, they want to increase the tax base. There's been a massive debate whether with the slowing economy and already burdened taxpayers, whether new taxes, increase in taxes should be implemented, but the government's currently promoting widening the net because there's a large swath of the Nigerian economy that's being left out and not being taxed. According to some estimates, Nigeria has the third largest informal economy as a percentage of GDP, to roughly 57% of GDP being informal, untaxed, and as a potential to be brought into the fold and help plug the government's hole in the budget.
I want to ask you about the hydrocarbon sector there. That's underperformed over the last few years. Are we expecting that to continue? And then how are we expecting that to affect the fiscus as well as this budget, Peter?
Yes, so Nigeria loves their oil. They love the hydrocarbon sector. It seems like the easy way to plug any hole, get a lot of money quick, which has created a lot of problems, as well as not enough investment into non-oil economy. However, at the moment, the government expects too much from the hydrocarbon sector. Production is not going to reach their target, and this might lead to a larger shortfall. As I said, the assumptions that were used to set up the budget. As I said, the government expects roughly 1.78 million barrels per day average next year, whereas we see it being closer to 1.4, 1.45, which would already be a significant improvement over the past couple of years. They also have, over the past 3 years since the pandemic ended, since the pandemic started, non-oil revenues has overtaken oil revenues as being the main source of revenue for the government, which is fantastic, increasing the tax base, especially if you can get more from oil. But one thing I have to admit that works in the government's favor is the devalued exchange rate. So typically hydrocarbons, oil exports and profits are captured in dollar terms, which means the weaker exchange rate would lead to more Naira revenue for the government. So this will be able to plug the hole, some of the hole. And also the government has very conservative estimates for oil prices in the low $70 per barrel, whereas we see it being over $80 a barrel next year. So they might see some upside surprises on that side.
Now, Pieter, I must also ask you about, the most prominent risk factors that could push the Nigerian government off course here. Of course, we can see that they're on a very deliberate path in terms of managing their economy.
So yes, as you know, over the past 6 years, the macroeconomy has changed drastically, inflation, exchange rate devaluations, as well as significant reforms. So apart from this trend continuing, which we do see happening, there's general one upside and one downside risk. So on the negative side, the downside risk would happen in the expenditure side. So there have been more threats of protests against the cost of living crisis, people being unhappy with the reforms, and should these swell to an extent where they can pressure the government to reverse some of the crucially implemented reforms or increase spending on grants and subsidies, it could tank this budget and make it virtually useless. So that's one of the main risks on the negative side. But on the positive side, they could see revenues increasing even further. As I've mentioned, oil price assumption is very low, so higher oil prices would benefit the economy, as well as the further depreciation or devaluation in their exchange rates. But the main thing is the giant Dangote oil refinery, which is seemingly edging closer to starting. And every time we look, it's getting closer. And as I said previous times in discussion with you, I'll only celebrate as soon as the first barrels finally come out of the refinery. But should Nigeria finally refine more expensive petroleum products and export them, maybe we would be able to lower inflation, especially fuel-driven inflation, and increase FX inflows, their external balances, and get a lot more fiscal revenues.
Certainly rooting for that Nigerian economy, Pieter. Thank you so much for your time today. That was Pieter Scribante. He's a senior political economist at Oxford Economics Africa.